This might be the single most important video you'll watch right now, because what's unfolding in the bond market could rewrite the rules for the global economy. If you're not locked in right now, you're not just behind, you're on the wrong side of the trade. Markets are undergoing a major shift, and it's exposing growing cracks in U.S. fiscal stability. Even though tariffs are on pause, the damage to global investor confidence is already done. The unpredictability of U.S. economic policy is leaving a mark, and if the Treasury market keeps wobbling, there's rising talk that the Fed might have to bring back quantitative easing, which simply means printing money to buy government bonds and stabilize the system. One of the clearest warning signs right now is the unusual behavior between U.S. bond yields and the Japanese yen. Typically, when U.S. Treasury yields rise, meaning investors want higher returns to lend money to the government, the U.S. dollar also tends to go up. That's because higher yields usually attract more global capital into the U.S., increasing demand for dollars. But that's not what's happening today. Despite U.S. yields moving higher, the Japanese yen is actually strengthening. This signals that something is breaking in the usual flow of capital. So why would the yen rise when it normally falls in these conditions? One reason is that Japanese government bond yields have also climbed recently. When yields in Japan go up, it makes domestic bonds more attractive to Japanese investors. Instead of buying U.S. Treasuries, which are now seen as riskier or less predictable, they may prefer to invest at home. That reduces foreign demand for U.S. debt, which adds pressure to the U.S. bond and currency markets. Importantly, this isn't about Japan running into fiscal problems. In fact, the strength of the yen tells us the opposite. If there were real concerns about Japan's debt situation, the yen would be weakening, not rising. Japan has a strong financial position thanks to the large amount of foreign assets it owns. This gives the country more room to handle its fiscal obligations, even if its government debt is large. The real story? Markets are no longer looking at headlines. They're pricing in a country's true financial strength. Nations with solid balance sheets and fiscal discipline are watching their currencies rise. But for deficit-heavy economies like the U.S., the tide is turning. Investors are pulling back, and the pressure is hitting both bonds and the dollar hard. One way to track this is by looking at how a country's net foreign investment position, more accurately called the Net International Investment Position, or NIIP, measures the difference between what a country owns abroad, like foreign stocks, bonds, real estate, and businesses, and what foreigners own in that country. If a country has more foreign assets than liabilities, it has a positive net international investment position, meaning it's essentially a global creditor. If it has more liabilities than assets, it has a negative NIIP, meaning it's a net borrower from the rest of the world. When a country with a large negative NIIP keeps running big budget and trade deficits, global investors may begin to worry. They may demand higher bond yields or higher interest to compensate for the growing risk of lending to that country. So when we say the relationship between NIIP and yields is getting steeper, it means the market is charging more to finance countries with weaker external positions. If that happens, the U.S. may return to a pre-2008 reality where the world demands much more compensation to fund its debts. And in that kind of environment, the dollar is likely to weaken. That weakening becomes the pressure release valve for America's growing fiscal imbalances. Now, earlier I mentioned that Japanese investors are shifting toward local bonds over U.S. Treasuries, and it's all about those rising yields. But here's the twist. Demand for Japan's super long bonds just hit the weakest level in over a decade. The real show might be unfolding in Japan, and it could be what breaks this entire market. Want to know why that's happening? Click the video popping up on your screen next. Trust me, you'll want to see the full story. If that gives you a clearer view of the markets, smash that like button, hit subscribe, and stay ahead of the curve, because the next big move starts with the right insight.